Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Game Plan for Retirement with Chris Mcintire. Mcintire Retirement Services, Northwest Ohio's retirement planning resource.
And welcome into the program. This is your Game Plan for Retirement with Northwestern Ohio's resource for that common sense approach to planning for our financial investment, retirement futures that we all need. He is president and founder of Mcintire Retirement Services, Chris Mcintire, once again with us. Chris, welcome back in.
Good morning. Good to be with you there, buddy. Hope everybody's doing well this weekend.
Always a pleasure, Chris. We appreciate the time, the guidance, the perspective that you provide here on the radio, on the podcast. For those listening or viewing, always resources that you can find out more information about mentioned on the program. You can click in the description below the video. We ask and encourage you to like, subscribe, and share this information with any friends, neighbors, loved ones that may also have questions about their money and finance, and who doesn't. Chris Mcintire's here as that resource to help answer and address those. So if you do have any questions, also feel free to give a call. He does offer the opportunity to get your game plan for retirement put together. 800-868-1194, the number 800-868-1194. You can also visit online, McIntyreRetirementServices.com, McIntyreRetirementServices.com. And so now that we've got the obligatory contact information out of the way, Chris, welcome to the unofficial start of summer, Memorial Day weekend. We celebrate with a cookout, but really what we're celebrating here is those who have paid the ultimate price and sacrificed for this country. So thank you.
Yeah, you're absolutely right there. And we want to thank everybody who's had a loved one in the military there, and special tribute to all of them. I live in an area here. We have one of the last remaining Tuskegee Airmen lives 5 doors down from us. So, I guess we probably all take a little bit of extra pride there. And my wife and I were at the Gettysburg battlefield many years ago, and they had the traveling Vietnam Wall there, and somebody had hung kind of like a dog tag there, and it said, freedom is favored by so many, but it is paid for by so few. So again, thank you for all you veterans out there listening to the show today, and all those that have passed on to preserve freedom.
Yeah, absolutely. We appreciate the sacrifice and the families who sacrificed with them as well. Thank you. But Chris, it is kind of the also unofficial beginning of summer, and a lot of people have vacation brain. They're sort of beginning to think about summers and kind of taking some time off, getting away. While we're doing that, life goes on, money continues to move, and we can't just completely put that on the back burner and forget about it, can we? There are some things we still need to be paying attention to.
No question about it. I like that vacation brain analogy too, buddy. Who doesn't have that, especially on a weekend like this? This coming week, I've got several days just scheduled away from the office, not a lot of appointments. And, sometimes we all need to do that. But again, the market doesn't take, a week off. Volatility doesn't take a week off. So, you still have to be mindful of everything that's going on economically here. We kind of been watching, the price of oil has escalated. Gasoline's certainly more now than it was a year ago. We got some supply chain issues out there. So a pretty big tug of war been going on here, kind of in that last part of the first quarter, and that's going to drag on here into the second quarter. And, sometimes there's an old analogy out there in the marketplace, a cliche. It says sell in May and go away and come back about Turkey Day. So, sometimes we see a fair amount of volatility here as the summer wanes on, and, maybe some of the companies' earnings weren't as good as what they thought they were going to be, right? Because when you announce earnings, or forecast your earnings, nobody's going to paint a dire picture. You want to paint a rosier picture, that drives your price up. But the reality sometimes hits too.
That's right. Yeah. Not every company's bottom line always lives up to expectations, even with healthy, profitable companies. And so, Chris, volatility is going to remain. However, I've got to sort of reflect on what we hear about in the news cycle more often than not. It is the market. It is the volatility. It's what's going on in Washington. it's interest rates, it's emergencies, it's international news. None of those things are within our personal control, right? And I don't think that we hear a lot of information or education on the things that we actually can do something about. And I know it's the news's job to drive headlines and viewers, and if it bleeds, it leads kind of thing. So they don't necessarily spend a lot of time. It's not their job, I guess, to educate us on the minutia of what we can control, how to place our money and those kind of things. But we don't hear a lot about what we can do, the steps that we can take in order to achieve certain goals and objectives. We hear more about those items that are beyond our control. And I think that there's some reason for that, but there's also a need to emphasize that even with those items beyond our control, there are steps that we can take to address them, to better protect ourselves against them potentially.
Yeah, we're such in a politicized world right now, and this instant news cycle and whatnot. And part of what my job is to try to cut through the emotion. I might meet with a client that is very disappointed in the direction of the company or country, I'm sorry, and where the news cycle is taking them. And how do you cut through that? And where is the economics come into play here? And I don't watch a lot of news in the evening time. I don't want to, it's always bad anyway,
right?
Yeah. In trying to cut through, and, I'd rather read than hear it, right? Because you can take it with a different grain of salt that way and cut out a lot of the emotion and the big banner headlines, breaking news. Everything is always breaking news because it captures your attention, and you have to try to disseminate that and realize that, look, I can't time the market. My success is typically going to be around the time I'm in the market in a portfolio that is well matched to what your overall risk tolerance is, and right now probably sensitive to, things that are going to be impacted by inflation. So you could say some, longer term US government bonds that pay a very low interest rate. And if interest rates are going to go up in the future, that certainly has added volatility to the bond market here. So, I guess the message here is, you got to be careful on that old 60-40 portfolio, if you will, 60% stocks, 40% bonds. With the interest rate being down so low now, are those bonds generating the amount of income that it made sense with a traditional 60-40 portfolio, or do we need to diversify some more of the bond holdings and, maybe look at real estate where you have income coming in from renters and leases and things along those lines, and also the appreciation of real estate to go up in value to offset some of that bond market volatility. That's a long-winded explanation, but a couple of things that we've been utilizing here and what we've been doing for our clients in the first half of 2021.
Now, Chris, there are some funds that are advertised as being intended to help us put some of that on autopilot, right? And I guess as we are entering the summer months and vacation brain is sort of taken over a little bit, I think that to some extent, people want to set a couple things on autopilot. Do those target date funds or life cycle funds, do they serve kind of a temporary purpose for us, or do they do as advertised and intended? Can we sort of just set it and forget it? Is there anything in the financial world that we can sort of set and forget?
Not necessarily, Peter. And those target date funds have become so popular in the 401k marketplace. We don't see them much outside of the 401k marketplace because people want to do some other types of diversification there. And again, they adjust by the calendar. I'm probably not the biggest fan of them all in all because they're almost oversimplified, if you will, and they make adjustments based on the calendar, not so much based off of the economics, and, so let's say, somebody that's in a 2020 retirement fund, hey, they might have an overexposure to government bonds that I wouldn't like, and so, with the interest rate environment and, allocating assets away from some of those types of asset classes instead of allocating more money into them just because we turned another page on the calendar, if that makes sense.
It does. And so I know that there is kind of a predetermined algorithm, we'll call it, of what the mix would be in some of those target date funds or life cycle funds. But what they don't do, if I understand correctly, Chris, is react to actual real world conditions that a lot of people probably would like to have their money kind of reflect what's going on in the world around them. And those funds don't do that. They don't take those events, those news headlines into account at all.
Yeah, that you're absolutely right. So a little more passively managed than actively managed. And again, building portfolios, well diversified, having some safe money strategies here to offset, volatility that can happen in the stock market, in the bond market, in the commodities market. Look at what the price of a 2x4 is nowadays. It's like $8 to $10 for a 2x4. So
I saw a sheet of plywood. It's near $50. That's crazy.
That is just insane. So, to take that even a step further, there are a number of supply chain issues, and, will the skyrocketing costs of lumber hurt the housing market, which could hurt the durable goods side of things. So that's something we're paying attention here into 2022 is, are we going to get an economic slowdown because inflation is ahead of where most consumers can keep up with the pace of the increasing prices? And that's a perfect definition of it.
Well, Chris, one thing I've always kind of enjoyed and appreciated on this program is you do give insight onto some of the indicators that you are paying attention to. And these are things that we need to understand on a high level at the very least. And then if we don't want to be full-time financial planners ourselves, trust somebody with our finances, with our investments and accounts, who is paying attention to these things and who can explain what they're paying attention to on our level. And I think that's what people are looking for in the relationship with the advisor. And once we have that relationship, Chris, maybe then we can have a little bit more vacation brain and put things kind of on autopilot if we have somebody who is watching the news, paying attention to those things, and helping us make sound long-term decisions with our money based on good data and research.
Peter, you bring up a wonderful perspective there. And, again, headline driven, emotional driven pieces hurt more investors than anything else out there. And again, I, try to coach clients, look, turn off the news, stop following it so closely and thinking, okay, I saw something bad, I need to sell and go into cash. That's not necessarily the case because, if you look back before we had a 24-hour news cycle, you didn't know what was going on until 6:30 when Dan Rather, Walter Cronkite, and Edward R. Murrow came on and told us what was going on, and we actually could believe what they said as well. And not now we have to interpret, okay, is that really what happened, or are we getting a slanted
is this
side?
news or angle? Yeah.
Yeah. So we've got to cut through, media bias and things like that are out there right now. And that's why I like to read, and, then I can pick who's writing it. Am I getting something from an editorialist or a true journalist, basically, so I still like to read the Wall Street Journal quite a bit. I think we're getting some of the more neutral side of things there, because everything's got there's a good side, there's a bad side. Typically, stocks can be wonderful. Stocks can also, be very distressing for you. And again, real estate can help offset some of that. Bonds can help offset some of that. Other safe money strategies that we help people do. In the CD world right now, we're helping a lot of people. You and I were talking before the show. You're helping some folks reposition some CD money as well, and what you also do for folks.
Absolutely. Well, lesson I learned from driver's ed, Chris, is that a majority of the serious accidents happen from overcorrecting. Maybe somebody, drifts a little bit, but when they realize it, they jerk the steering wheel the opposite direction. And that's actually a cause for a lot of the accidents that occur. And so, paralleling that, using it as an analogy, a lot of people have these kind of knee-jerk reactions to momentary flashes of news or something that they're feeling is veering the wrong direction, and it can end up leading to a mistake. That's why we need to have and stick to kind of a long-term plan. Having that plan will allow us to a little bit, take the hands off the wheel, set it on cruise control, not have to pay as much attention.
Yeah, no question about it, Peter. Often the reaction is worse than the actual event that created the distress that you reacted to. No question about it. And that's just human nature, is to react emotionally. And if you don't think we react emotionally, why am I wearing a green shirt today? And why do I have one vehicle that's one color, another vehicle that's another? We make emotional decisions by and large. Not everybody's going to spreadsheet out all the critical analysis like what the engineering types are going to do.
Yeah, love my Excel spreadsheets, but Chris, when I look at them, I'm trying to project out, and I'm trying to protect myself against things that I cannot control. You've mentioned a few times safe money strategies. Are these options for us if we do want to be a little bit more hands off and maybe not have to deal with wild swings and volatility?
Yeah, we love safe money strategies, and we try to utilize them to, again, cushion against downside, remove the emotional element. So if somebody's got a portfolio of, a basket of stocks, and the stocks are down significantly, that, they can go over and switch over and start drawing money off of their safe money supply. We do that quite often. Here we've had a nice, call it a roaring stock market, if you will, here since the onset of the pandemic. And, but when the pandemic hit and portfolio values went down, we went to our clients that are drawing income and said, look, let's switch over, take money out of the safe strategy and give this time to recover. And that's obviously paid off very well. Certainly the right thing to do. You never know when that bounce is going to take off. And who would have thought that, in a pandemic that has killed millions of people around the world, 600,000 people here in the United States, that we'd have had one bad month, and look what happened to the economic carnage of it. And part of that is in credit to government stimulus that came in and rode to the rescue. Now, that's also going to cause some economic issues down the road with inflation and how do we pay off the debt and all of those things. Because it's wonderful getting free checks from the government and all of it, but someday somebody's going to have to pay that back.
Yeah, always ripple effects for any action. Chris, are there any other, maybe we'll call it overlooked areas in planning, items that we could address that would help us have more control in determining our outcome?
Peter, the sequence of returns risk is a huge one that many people don't consider. I just went through this process with a client who just retired and is doing very well, but she has been an investor, not a withdrawer, if you will. So her portfolio now is shifting from where I've been putting money into it every month to where I'm going to take money out of it. And her thought process is, hey, I'm going to be all in. And whatever the market does, I'm going to get what the market does. I don't want to leave any money on the table if the market runs. And so I had to go back through and show her some illustrations on, look, it's not about getting all of the upside. It's about limiting the downside damage when you're taking money out of it. That's the sequence of returns. And, we've talked about that in, on radio show, it's kind of hard to talk about something that people need to see. But, for example, if you would have retired in 1999 and started pulling money out of your portfolio, the first 3 years you had 2000, 2001, 2002, where the market fell, in that 40 to 60% range, depending if it was the S&P or the NASDAQ. Whereas if you would have retired in 1996, you had 3 solid years of growth before we had an economic calamity. And the difference in those is astounding when you factor in the withdrawal rate risk or the sequence of return risk as well.
But we can't time the market, Chris. And that's why during our working years, setting up some type of systematic, regular, automatic deposits to the market, no matter where it is actually helpful. That's an inherent advantage. It's one of the fundamental principles of long-term financial success is dollar cost averaging. But what you're talking about is kind of the opposite of this, because now the money has changed directions. It's as much a potential danger and disadvantage as we are making withdrawals as it is a benefit when we're making deposits.
Correct. Yeah. When the market goes down and you're putting money in, you're buying more shares when it's down low. When the market is down and you're pulling more out, you might be taking out more than that 4% withdrawal rate. And, unfortunately, most people that are listening to the show today are thinking of, well, the market went down in March and it skyrocketed since, well, hey, look at the last time we had some serious inflation in this country in the 60s and 70s, and look what happened to the stock market. I mean, we went a decade and it went up 1.37%.
Yep.
I mean,
And not the only time in history where we've gone an extended period of time and not had significant market growth.
Yeah, and you have to be positioned for some of those events happening. It's not like they forecast it and say, hey, we're going to have terrible growth for the next 10 years. You typically aren't going to know that until you're 7 years into it, right? And
it would be nice if they could forecast that. Unfortunately, they can't. But Chris, I remember back to the downturn from COVID in March, my bills stayed about the same from February to March to April. The companies didn't call me and say, hey, we're willing to accept 40% less because we know the market's down 40%. And in retirement, if we got years that may be down years in the market, we're going to have to figure out how to generate that income. And that's another area where I think we can control that or position assets in a way that gives us an advantage, but we're not receiving a lot of information or education about those options and alternatives. It's all about invest and aim for growth and accumulate as much as possible, shoot for rates of return. It's not really about consistency until they say, oh, well, the market's averaged 9%, but you can't count on that reliably.
You're exactly right, Peter. And to extrapolate that further, back in, what was it, 2007 or so, the short-term interest rates were 5.5% basically. Now those rates are at 0. So, for folks concentrated on, not having money invested in stocks, but in bonds because they want to be safer, you're doing that at an incredibly low interest rate environment when most of them grew up and put their money in when we had a much higher interest rate environment. So mentally, they haven't changed the paradigm on, am I too concentrated in bonds in retirement because I'm using old school economics in today's environment where, you got a significant amount of interest rate risk.
Yeah. And the old adage of protect the principal, live off the interest has become increasingly difficult because of the low interest rates. And that's actually pushing a lot of savers, more conservative minded investors to taking a little higher risk than may be appropriate or they may be comfortable with.
Yeah, no question about it, Peter. We're utilizing, a number of different, investment pieces here. Can't go into all the details. We don't have enough time, but, to spin off higher yield that aren't your traditional stock or bond piece. Yes, we love dividends, we still need bonds. They play a place in a portfolio to cushion against larger drawdowns, but we also even have to diversify kind of that bond side of things. So, we do that a lot with a quality fixed index annuity that has no downside potential, and we can get some upside linked to the performance of a stock market index. We can utilize some real estate for that, and and some hybrid bond pieces as well with what are called structured notes, and some unique pieces there tied to the indices, if you will.
So our strategies, there are strategies that are available to help us reach the goal and achieve the goal of protecting and lessening market volatility and its potential effects on us. Again, they talk a lot about the market volatility. That's what we hear in the news, but they don't talk about those alternatives that you're mentioning here, Chris, that could be attractive to a more conservative minded investor that wants to still have the opportunity for growth or to produce a more reliable income base. And ladies and gentlemen, that's why you should reach out to a qualified, experienced professional, somebody that is looking out for your best interest when putting the plan together and making recommendations. That is what the game plan for retirement is all about, that Chris Mcintire has offered to put together for listeners to this program. It's a snapshot of where you are now, a discussion of your goals, and then executable action items, recommendations, and a timeline of when you should be acting on those recommendations and those items. And that's what the game plan for retirement's all about, addressing your investments, your income, taxes, healthcare, legacy, the big issues that savers and investors have on their list of goals. And there's no cost, no obligation to get started. Pick up the phone, give Chris Mcintire a call at McIntyre Retirement Services, 800-868-1194, 800-868-1194. Chris, taxes, I mentioned that as one of the areas. That's another one where we hear the headlines and we as individuals a little powerless to really do anything about the big sweeping changes that may occur with taxes and tax laws. We know we got to pay them sooner or later. Not really a dollar ever created or grown or transacted that does not have some kind of tax associated with it. But there are steps, there are strategies, there are things that we can do to better control our tax liability. And those sometimes don't receive enough time and attention.
Yeah, Peter, I would agree with you. I love the Roth conversion is probably the most popular one for folks listening to the show here today, is sliding money that's in your IRA into a Roth IRA. We call that a conversion process, right? Because you can do two things with IRA dollars. You can contribute to them or you can convert them. If you're retired, all you can do is convert. If you're still working, you may be able to contribute and to convert. So we work hand in hand with a number of CPAs here to say, hey, let's run a couple of what if strategies. Can Mr. Smith take out $40,000 out of his IRA and not go into the next income tax bracket and slide that into a Roth IRA and pay tax on that $40,000, but the Roth IRA grows tax deferred, and then the distributions become income tax free, and it's also income tax free to your beneficiaries as well. Capital gains taxes for non-IRA assets. We always want to look at, if you've got something that's at a loss, all right, let's lock in, sometimes we'll sell and lock in a loss because then we can use that loss to offset a gain in the future. So, just because an asset is down in value doesn't mean you can't sell it. You can always rebuy it 31 days later. Okay. And get a new cost basis, but you may have locked in a loss that may come back to be an advantage for you in the future. That's the reality of investing. Nobody bats 1,000, but instead of just saying, well, I can't sell it because it's down, it's like, where's that written? You can sell it whenever you want to. Does it make sense to buy it back is the other question.
Yeah, well, I don't want to sell it now. I'll have a big taxable gain, Chris. It's something that we hear a lot, but I'd rather have that gain than a loss, right?
Yeah, because the capital gains rate is determined by your income tax rate. So the money you earn, the money you get from a pension, the money you take out of an IRA, that's income tax. And if you're only in the 12% income tax bracket, you pay zero long-term capital gains taxes. Long-term just means you've owned the asset for more than a year. So, I like working on the tax side of things here because I think it's an area where, we may have a competitive advantage. We're certainly a little more proactive than, all right, put some money in and we'll see you when you need to take some money out. And that's not necessarily what our practice is set up for.
No, and I know, Chris, that there are opportunities to better control that tax liability. A lot of people overlook them. That can potentially be one of our biggest expenses, specifically in retirement. During our working career, we've been told to defer and delay paying taxes on a good bit of our savings, typically on that 401k or that IRA. Most people made the conscious decision to kick the can down the road and wait until retirement to pay the taxes. And therefore, we really need to strategize on how to bring that tax bill down once we do retire and keep as much of our money as possible.
Peter, I couldn't agree more with you on that point right there. So many people are using the old school paradigm or the analogy that, delay taxes for as long as possible. And yeah, that was certainly true, 15, 20 years ago when income tax rates were a lot higher. Right now, they're very low. And we've heard the new administration that has come in, talked about doubling the capital gains taxes, and they might say on the rich or, and increasing the corporate taxes. Well, guess what, guys? The top 1% aren't going to pay all of the bill. That some of those things are going to be adjusted and You can always tell when a politician's lying when his lips are moving. I'll leave it at that. And that's not partisan, so you can't go there.
Well, when they tell us that they are going to be increasing taxes and doing it in several categories, we've got to pay attention to that, Chris. And we do need to know what we can and cannot control. Probably any individual single one of us, any listener to the program as an individual, does not have a lot of say-so over what changes in Washington, what tax rates we're going to be paying into the future. But we do have control over the steps we take today to strategize and minimize the taxes that we pay. Those are the things that we actually need to be paying attention to. And just because we're hitting the summer months and getting into that vacation stride and mentality doesn't mean that we set these things on autopilot and forget about them. In fact, Chris, this is one of the best times to get an extra little bit of planning done, to sit down. You offer to put that game plan for retirement together for folks. And a lot of savers and investors across Northwestern Ohio have seen some great advantages from that.
Thank you, Peter. Yeah. We enjoy providing our services here to the folks on the show. We've been doing this show. It's probably got to be coming up on 10 years here. And we take a lot of pride in trying to put out neutral information here for folks, not have a bias here one way or another, explain what the options that they have are and help them make clear, concise decisions on some very important factors. Do you want to leave a legacy to your children? Is that the focus at this point in your life? If you've just retired, that's probably not your big focus. It's structuring income so you don't run out of money. Okay, we can help you with that. What's the most efficient way to build some to take money out from a tax standpoint and whatnot. And, that's one of the favorite things I like to do. And obviously we have portfolio design and construction and safe money strategies, outside of Wall Street.
Well, if you would like to learn more, or if you would like to get that game plan for retirement put together, pick up the phone, give Chris McIntire Retirement Services a call, 800-868-1194. That's 800-868-1194. Chris, always appreciate the informative conversation, the insight, the guidance that you provide for Northwestern Ohio savers and investors. Thank you for being here.
My pleasure. Everybody have a good weekend. Thank you for listening. And again, thank you to all the veterans and everybody that's had a loved one that served in this military for this fantastic country we get to call home.
Visit McIntyreRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Indexed or fixed annuities are not designed for short-term investments and may be subject to caps, restrictions, fees, and surrender charges as described in the annuity contract.